The Echoes of History, December 2025. The stock market is at record highs. The experts say everything is fine. And almost nobody hears the echoes of 1929 growing louder every single day. The same patterns, the same mistakes, the same blind confidence that preceded the greatest economic disaster in modern history. Most people look at rising markets and see prosperity. They see record highs and assume everything is under control. But the smart money, they see something else entirely. They see 1929 happening all over again. When we think about the Great Depression, we imagine bread lines stretching around city blocks, families losing their homes, a nation brought to its knees. But here's what most people miss. The real story isn't what happened after the crash, it's what led up to it. The Roaring '20s weren't just about jazz music and dancing flappers. They were about a financial bubble so massive, so intoxicating, that an entire nation convinced itself the party would never end. Sound familiar? It should. Because right now, every major warning sign that preceded the 1929 crash is flashing red. The extreme wealth inequality, speculative mania, the easy credit flooding the system, the government's desperate attempts to keep the machine running. We're not heading toward a repeat of history. We're already living it. Here's what should terrify you. September 1929, just weeks before the crash, one of America's most famous economists, Irving Fisher, declared that stock prices had reached what looks like a permanently high plateau. The newspapers agreed. Politicians promised that boom and bust cycles were a thing of the past. Revolutionary technology was going to change everything forever. And then, in a matter of weeks, fortunes built over decades vanished. Banks that seemed unshakable collapsed. The confidence that had fueled everything evaporated like morning mist. Two eras. One mistake in 1928. America looked unstoppable. It was actually 12 months from collapse. The stock market had been climbing for nearly a decade. Everyone from Wall Street bankers to factory workers was playing the market. Credit was flowing like water through the streets. People were buying stocks on margin, putting down just 10% and borrowing the rest. They were mortgaging their homes, cashing in their life savings, convinced that prosperity was permanent. The Dow Jones had surged sixfold in just 8 years. From 63 points in 1921 to 381. By September 1929, newspapers called it the new economy, a new paradigm where the old rules of valuation simply didn't apply anymore. Technology was the fuel. Radio was the artificial intelligence of its day. Radio Corporation of America stock soared to 500 times its earnings. People convinced themselves that traditional metrics did not matter. When you were dealing with revolutionary technology, that would change everything. Now look at today. Since the pandemic lows, stock markets have experienced one of the most explosive rallies in history. The total value of the American stock market compared to the entire economy has reached its highest level ever recorded. Higher than 1929. Higher than the dot-com peak. Higher than 2008. Warren Buffett, one of the most successful investors in history, has a simple rule. When that ratio hits 70%, it's a good time to buy. When it approaches 200%, it's flashing red. A signal we saw before the dot-com crash, a signal we saw before the 2008 financial crisis. Today, we've blown past those levels entirely. Just like in the 1920s, there's a revolutionary technology driving the mania. Artificial intelligence. Companies with no profits are valued in the hundreds of billions. Tech giants have pledged to spend over $300 billion this year alone on AI infrastructure. Global corporate AI investment hit $250 billion last year, growing 30-fold in just a decade. Yet studies show 95% of AI pilot projects fail to produce meaningful results. The big tech companies have invested over $500 billion in AI infrastructure, but have generated just $35 billion in AI revenue combined. The gap between investment and actual returns is staggering. But the market keeps climbing. It's just like it did in 1928. It's just like it did in 1929. Back then, anyone who suggested this might end badly was dismissed as a pessimist who simply didn't understand the new paradigm. The same dismissals are happening today, the same arrogance, the same absolute certainty that tomorrow will be better than today. History doesn't repeat exactly. but it rhymes with a rhythm that's getting harder and harder to ignore. The speculation epidemic in the months before the Great Crash. Roughly 600,000 Americans held margin accounts. They were borrowing money from brokers to buy stocks they couldn't actually afford. Put down 10%, borrow the rest, and pray the market keeps going up. When it didn't, those margin calls triggered a cascade of forced selling that turned a correction into a catastrophe. Today, margin debt has exploded past $1.18 trillion. It's trillion with a T. It hit record highs 6 months in a row this year. Since April alone, margin debt has surged 39%. The last time we saw that kind of 5-month spike was October 2021, 2 months later. Stocks began a collapse that wiped out 25% of the market. But here's what nobody in the mainstream financial media will tell you. Margin debt is just the tip of the iceberg. It's the only leverage we can actually track. Hidden beneath the surface is an ocean of borrowed money that doesn't show up in any official statistics. Hedge funds borrowing from prime brokers, executives pledging their shares as collateral for personal loans, complex derivatives that amplify bets by 5 times, 10 times, even 20 times. The number of leveraged stock market funds has exploded past 700 this year alone. It's up 40% from last year, nearly tripled since the pandemic. These aren't investment vehicles. They're casino chips, dressed up in financial jargon. And it's not just Wall Street anymore. Everyday Americans are gambling with money they don't have on assets they don't understand. Cryptocurrency speculation that makes 1920s stock pools look tame. Meme coins that rise 1,000% in weeks on nothing but hype, then collapse just as fast. Trading apps that turned investing into a video game, complete with confetti animations when you make a trade. In 1929, the Federal Reserve tried to warn people. They raised interest rates. They told banks to stop lending to speculators. Nobody listened. Today, the warnings are everywhere for those willing to see them. Record margin debt. Record leveraged funds. Record valuations disconnected from reality. But the music is still playing, and everyone keeps dancing. When the margin calls come, and they always come, the selling won't be gradual. It will be instant and merciless. Algorithms will accelerate the collapse at speeds that would have been unimaginable in 1929. What took weeks back then could happen in hours today. The speculation epidemic is terminal. The only question is when the patient finally collapses. The debt time bomb, there's a number that should keep every American awake at night. $18.59 trillion. That's how much debt American households are carrying right now. A record high, the highest in history. And it's growing every single quarter. But that number alone doesn't tell the full story. It's what is hiding inside that mountain of debt that reveals just how fragile this entire system has become. Credit card debt has crossed $1.23 trillion, another record. Americans are paying 22% interest on balances they can't pay off. The average household is carrying nearly $10,000 in credit card debt alone. And delinquencies are surging. Nearly 7% of credit card balances are now transitioning into default. The highest rate since the Federal Reserve started tracking. Student loans, $1.65 trillion. Auto loans, $1.66 trillion. Mortgages, $13 trillion. Every single category is at or near all-time highs. In 1929, Americans were leveraged to the hilt on stocks. Today, they're leveraged on everything. Their homes, their cars, their education, their daily expenses. The entire consumer economy is built on a foundation of borrowed money and borrowed time. But here's what the financial experts won't tell you on television. The people who can least afford this debt are the ones drowning in it. While the wealthy top 20% drive the majority of consumer spending, the bottom half of Americans are living paycheck to paycheck, exposed, vulnerable, one job loss away from catastrophe. Nearly 6 out of 10 Americans cannot cover a $1,000 emergency expense, not without borrowing more money, not without sinking deeper into the hole. And the cracks are already spreading. Serious delinquencies, loans, 90 days or more past due, have surged to levels not seen since 2011. Student loan defaults have exploded since payments resumed. The flow of debt into serious delinquency has nearly doubled in just 1 year. Federal Reserve Chair Jerome Powell himself admitted, "We're looking at a bifurcated economy. Those at the top are thriving. Those at the bottom are struggling, buying less, trading down to cheaper products just to survive. In 1929, when confidence broke, the system collapsed because everyone was over-leveraged on one asset class: stocks. Today, the leverage is everywhere. It's systemic. It's woven into the fabric of daily American life. When this confidence breaks, and it will break, the collapse won't just be financial. It will be personal. Millions of families, millions of homes, millions of lives built on debt that was never sustainable in the first place. The time bomb is ticking. Almost nobody hears it. 0.5%. Less than they did 35 years ago exposed. That 66 million families fighting over scraps while billionaires add another trillion to their fortunes every few years. This isn't just a moral issue, it's a mathematical time bomb. Here's what the economists understood in 1929 and what today's experts refuse to acknowledge. When wealth concentrates at the top, the entire economy becomes unstable. The rich can only buy so many cars, so many houses, so much food. Real economic growth depends on the broad middle class having money to spend. But that middle class is vanishing. In 1963, the wealthiest families had 36 times the wealth of middle-class families. Today, that gap has exploded to 71 times. The American dream of working hard and getting ahead has become a mathematical impossibility for most people. And while ordinary Americans drown in debt just to afford groceries, something else is happening. The billionaires are quietly preparing. Warren Buffett's Berkshire Hathaway is sitting on over $150 billion in cash, the largest reserve the company has ever held. He's selling, not buying. Billionaires are acquiring farmland at unprecedented rates. They're building bunkers. They're moving assets into gold and hard commodities, while telling everyone else that everything is fine. Central banks around the world are stockpiling gold, while publicly calling it a barbarous relic. Insider trading by members of Congress has reached record levels. The people with access to real information are positioning themselves for what's coming. Meanwhile, the general public keeps buying the lie. The economy is strong, they're told. Technology will save us. Trust the experts. But the experts are either blind or they're lying, because the same wealth concentration that destabilized the economy in 1929 has reached even more extreme levels today. And history tells us exactly what comes next. When the foundation cracks, it's not the penthouses that collapse first. It's everyone below them, and almost nobody sees it coming. What the smart money knows, the wealthy are quietly escaping while telling you to stay on board. Warren Buffett didn't accumulate $150 billion in cash because he's optimistic. He's been selling bank stocks, Apple shares, positions he held for decades. The Oracle of Omaha is sitting on more cash than at any point in his 70-year career. When the greatest investor alive is hoarding cash at record levels, that's not a coincidence. That's a signal. But it's not just Buffett. Exposed. The insiders are dumping shares at the fastest pace in years. Corporate executives are exercising stock options and selling immediately. They're not holding. They're not believing their own projections. They're getting out while the getting is good. Meanwhile, the same banks telling you to buy are quietly changing their own positions. They're recommending stocks to retail investors while their proprietary trading desks move into defensive assets, gold, treasuries, cash, and the billionaire class. They've moved beyond financial preparation entirely. They're buying farmland. Hundreds of thousands of acres across America. They're constructing luxury bunkers in New Zealand and remote mountain compounds. They're acquiring private islands and citizenship in countries with no extradition treaties. These aren't vacation homes. These are escape plans. Why would the wealthiest people on Earth prepare for societal breakdown if everything is as stable as they claim? Here's what they understand that the average person doesn't. This system is not designed to protect you. It's designed to extract from you. When the music stops, there won't be enough chairs for everyone. There never is. The bailouts will go to the banks. The losses will go to the people. We saw it in 2008. Exposed. The institutions that caused the crisis got rescued. The families who lost their homes got nothing. The same playbook is being prepared again. Only this time, the bubble is bigger. The debt is higher. The concentration of wealth is more extreme. And the tools they used to fight the last crisis have been exhausted. Interest rates were already near zero for over a decade. Government debt has exploded past $35 trillion. The Federal Reserve's balance sheet is bloated beyond recognition. The breaking point, so when does it all come crashing down? That's the question everyone wants answered. The exact date, precise moment, as if knowing the day would somehow make the fall easier to survive. But here's the truth that history teaches us. Nobody rings a bell at the top. In 1929, the crash didn't happen overnight. It was preceded by months of warning signs that most people either ignored or rationalized away. Stock prices had become completely disconnected from reality. The Federal Reserve raised interest rates to cool the speculation. Small cracks appeared in March. The market wobbled, then recovered. Everyone exhaled. See, they said, nothing to worry about. Then came October. Between September and November of that year, the Dow Jones lost nearly half its value. Fortunes built over decades vanished in weeks. The confidence that had fueled the entire system evaporated, and it kept falling. By 1932, the market had collapsed 18.9% from its peak. Dollar invested in stocks shriveled into barely more than a dime. It took 25 years for the market to recover. An entire generation lost. Now look at today. Every box on the pre-crash checklist has been ticked. Record valuations disconnected from earnings. Check. Unprecedented speculation funded by borrowed money. Check. Extreme wealth concentration, strangling the real economy. Check. Consumer debt at all-time highs with rising delinquencies. Check. Political leaders dismissing warnings as fear-mongering. Check. Experts insisting this time is different. Check. The stage is set. The actors are in position. But here's what makes our situation even more dangerous than 1929. Back then, most Americans still lived on farms or in small towns. They had skills. They could grow food, fix things, survive without complex systems. The stock market collapse devastated the economy, but people had a foundation to fall back on. Today, we're utterly dependent on supply chains that span the globe, on digital payments that require functioning networks, on institutions that exist only because of confidence and credit. When that confidence breaks, the collapse won't just be financial. It will reach into every corner of modern life. And unlike 1929, the speed will be incomprehensible. Algorithmic trading can amplify a crash in milliseconds. What took weeks then could happen in hours now. When the selling starts, it won't be gradual. It will be a tsunami. The patterns are unmistakable. Echoes are deafening. The people who should be preparing us for what's coming are either clueless or complicit. History doesn't repeat exactly, but it punishes those who refuse to learn from it. The 1929 crash is happening again. The warning signs are everywhere, and almost nobody sees it. The only question left is which side of it you'll be on when the curtain finally falls. The illusion of safety, there's a lie that's been repeated so many times that everyone believes it now. The government will save us. The Federal Reserve has the tools. The system has safeguards. What happened in 1929 can never happen again. This is the most dangerous delusion of all. After the Great Depression, regulators built walls. The Glass-Steagall Act separated commercial banks from investment banks. The SEC was created to police the markets. Circuit breakers were installed to halt trading during panic sell-offs. Everyone assumed the fortress was secure, but those walls have been torn down. Glass-Steagall was repealed in 1999. The same banks that hold your savings now gamble in the same derivatives markets that destroyed the economy in 2008. The regulations that followed that crisis have been quietly gutted, lobbied away, watered down until they're meaningless. And the tools they use to fight past crashes, they're broken. In 2008, the Federal Reserve slashed interest rates to zero. They printed trillions of dollars. They bailed out the banks and called it economic rescue. It worked, they said. Crisis averted. But they never fixed anything. They just delayed the reckoning and made it worse. Interest rates stayed near zero for over a decade. Money printing never really stopped. Government debt exploded from 10 trillion to over 35 trillion. The Federal Reserve's balance sheet ballooned to nearly $9 trillion. They used every bullet they had to fight the last crisis. Now, the chamber is empty. When this bubble bursts, where do rates go? They're only just coming down from the inflation fight. How much more can they print before the dollar itself collapses? How much more debt can the government take on before the entire system loses credibility? There are no more bailouts big enough, neither more tricks left, nor more safety nets waiting to catch the fall, in the institutions people trust most. They didn't see 2008 coming. They didn't see the dot-com crash coming. They assured everyone in 1929 that stocks had reached a permanently high plateau. The experts keep you calm, not because it's true, but because your panic would trigger the very collapse they're desperately trying to hide.